We continue with performance management. Specifically, we are taking more questions on variance analysis. Yesterday, we looked at variance. As the difference between your budget and actual. We explained that there is similarity between budget and variance. We said budget, if you recall. Your budget is the monetary value of what the company plans to achieve. At the end of the financial year, you now have the actual results. When your actual results is different from your budgeted plan, that gives rise to variance. For example, your plan is to achieve 10 million naira profits. At the end of 2026, your plan is to achieve 10 million naira profits. When we get to end of December 2026, you now look at the actual profit achieved. Assuming the actual profit is 8 million. And your budget is to achieve 10 million. That means there's a variance of 2 million. You now try to investigate the variance. The process of investigating the difference between your budget and your actual results is what we call variance analysis. We now discussed this yesterday. We look at the cost variance, we look at the sales variance, cost variances, sales variances. Then we solved 2 questions yesterday. Tonight, we are going to advance in knowledge. We are going to look at material mix variance and material yield variance. We shall discuss material mix and material yield variance. We shall discuss sales mix and sales quantity variance. And we shall discuss planning and operational variance. We have just like 20 minutes. When you say material mix and material yield variance, when 2 or more raw materials are used to produce a single product, where 2 or more raw materials are mixed together, are used together to produce a single product, it is possible to further subdivide material usage variance into material mix and material yield. Please note, You are going to be talking of material mix and material yield variance, where two or more raw materials are used to produce a single product. It is possible to further subdivide material usage variance into material mix and material yield. What is material mix? Like we did yesterday. Your material mix variance is where actual material mixture is different from standard material mixture. Your material mix variance.
Samuel.
Please, Baba Samuel, please mute. Please help us mute. That is Samuel. Material mix variance, where the actual material mixture is different from standard material mixture. This is calculated as actual quantity actual material quantity, calculated as actual material quantity in standard mix minus actual material quantity in actual mix. Put a bracket. Multiply by the standard price. Actual material quantity in standard mix minus actual material quantity in actual mix, multiply by the standard material price. That is how to get your material mix variance. You may write it down if you want. Your material yield variance. Material yield variance occurs where actual output is different from expected output as a result of differences in material mix. Material yield variance. This occurs where actual output is different from expected output as a result of differences in material mixture. It is calculated as standard material in standard mix minus actual material in standard mix multiply by the standard price. You may write it down if you want. So you can further subdivide material usage variance into material mix and material yield variance if two or more raw materials are used to produce a single product. That is number one to be explained. Number two, sales mix and sales quantity variance. Let's explain this. Where a company produces and sells two or more products. Where a company produces and sells two or more products that are substitutable. Where a company produces two or more products that are substitutable. For example, Coca-Cola, Nigerian bottling company. We have Fanta. We have Coke. We have Sprite. If you want to buy Coke and there is no Coke, you might choose to buy Fanta or Sprite. If you want to buy Sprite and there's no Sprite, you might choose to buy Coke. These products are substitutable. Where a company produces and sells two or more products that are substitutable in the eyes of the consumer, that are substitutable in the eyes of the consumer, it is possible to further subdivide sales volume variance into sales mix variance and sales quantity variance. You can further subdivide your sales volume variance into sales mix and sales quantity variance. Sales mix variance. Your sales mix variance where actual quantity sold in actual mix is different from actual quantity in standard mix. Where the actual quantity sold in actual mix is different from actual quantity in standard mix. There are differences in mixture, sales mix. If you look at Nigerian bottling company, if you take a crate of Coke, you have what we call sales mix. In that crate of Coke, they might have 18 bottles of Coca-Cola. Or 16 bottles for Coca-Cola. 4 bottles for Sprite. 4 bottles for Fanta. That means there's a particular mix in that crate. Your sales mix, where actual quantity in actual mix is not the same with actual quantity in standard mix. Our sales mix variance, sales mix variance is calculated as actual quantity sold in actual mix minus actual quantity sold in standard mix. Get the difference? Multiply by your standard profit. Multiply by standard profit. You are going to use standard profit, like we explained yesterday. If you are talking of absorption cost, but if the question is on marginal costing, then you are going to use standard contribution. This will give you your 6 mix. Your 6 quantity variance. This is calculated where your actual quantity in standard mix is different from your budgeted quantity in standard mix. Calculated as actual quantity sold in standard mix minus budgeted quantity in standard mix multiply by standard profit. We use this to calculate sales quantity variance. Then our last explanation. Planning. Please, can you guys do me a favor? November diet, last diet question. I think question number 3. Can somebody download and share with the group? You can screenshot that question number 3. Let us look at that question together. So question number 3, screenshot and share with the group. Planning and operational variance. Planning and operational variance. What is planning variance? What is operational variance? First, let's start like this. If you look at your variance reporting, variance reports can be used for performance evaluation. Variance reports can be used to evaluate the performance of the production workers. However, these reports must be used with a caution. This is because the standard, the original standard, might contain errors. The original standard might contain errors, and this standard may be outdated. Ramon, please can you mute? Or do you have any question? Where there is error in your standard, that standard cannot be used to evaluate performance of the workers. Hence, that standard must be corrected. Planning variance is used to measure the amount of errors included in the original standard. Planning variance is used to measure the amount of errors included in the original standard. Our planning variance is calculated as planning variance is calculated as X ante standard minus X post standard. Your X ante standard is standard is original standard that contains errors. S post standard is the revised standard without errors. So please don't forget, examiner can tell you to calculate price planning variance. That is, we want to know the amount of errors in our pricing. Price planning variance. If I say calculate price planning variance, I'm asking you to tell me the amount of errors in my price forecast. You know, standard is based on forecasting. I plan to buy this product for 10 naira if I get to market. The standard price. If I get to market, I should be able to buy this marker for 10,000 naira. That is my plan. Meanwhile, I'm looking at that 10,000. Maybe that 10,000 is a price for 2 years ago. I didn't know. On getting to market, I say, no, this 10,000 you are talking about is a price for 2 years ago. That means that price I'm using is outdated. I'm using an outdated standard. That standard is not relevant again. So you are trying to look at the amount of errors in your original plan. Now, operational standard. Now, planning variance enable us to know the amount of errors in our standard. We cannot blame workers for errors committed by management. For example, management said, produce these products for 1 hour. That we are giving you 1 hour, standard hour, to produce a particular product. You now resume work. You now spend 1.5 hours. Management will assume that you are inefficient. Meanwhile, that 1 hour set by management is actually wrong. Maybe the standard hour should have been 1 hour 45 minutes. Somebody now said, what you should have done for 1 hour 45 minutes. Somebody said, go and do it for 1 hour. That means if you are taking more than 1 hour, it's not your fault. It is because there is error in the original standard. We use planning variance to determine the amount of errors in our original standard. We now have operational variance. Operational variance. Operational variance compare expo standard and actual results. Operational variance, difference between ex post standard minus actual results. In this case, you are using a standard without error against to compare your actual results. A revised standard without error. You are now comparing it to your actual results. Any resulting variance, the resulting variance from operational variances can be used to measure performance. Resulting variances from operational variance can be used to evaluate performance of production workers. All right. Oh, thank you. Somebody has shared with the group. So please, we can use this question to explain sales variances and planning variance to some extent. Let's use the most recent question. Let me equally share with VI students. So if you are joining the class from VI, you can check your group chats. We are starting with last diet question.
Sir,
We are hoping to be able to take your question.
I have no business with him in the first place, so why are you bothered about it?
Mr. Larry, please, can you mute?
Oh, I'm sorry. Sorry, I didn't know.
So please, you can look at the question, pick it from the group chat. Ijaye, thank you for sharing with the group. Any question, any clarification? Now look at the question on your screen. You can equally refer to your group chat. Let's go on with this question. The question was tested for 20 marks. I'll read. Colade Electronics. Colade Electronics Limited is an electronics assembly company which makes two types of television: plasma screen TV and LCD screen TV. The company operates within a highly competitive market and is constantly under pressure to reduce prices. Colade Electronics Limited operates a standard costing system and performs a detailed variance analysis of both products on a monthly basis. Extracts from the management information system for the month of July 2025 are shown below. You have it. Total number of units made and sold. That is actual production. Total number of television manufactured and sold, 1,400. Material price variance, 56 million advance. Total labor variance, 60.5 million advance. Let's look at the notes. Note 1, 2, 3. Note 1. The budgeted total sales volume for televisions was 1,180. Look at it. Our budgeted sales for TV. Our plan is to sell 1,180 units of TV, consisting of equal mix of plasma screen TV and LCD TV. Let's break that down. Our plan is that total television budgeted sales 1,180. Out of this is going to be equal mix. 50% for plasma TV, 50% for LCD TV. Actual sales volume 750 plasma TV and 650 LCD TV. If you sum these two together, 750 plus 650, you are going to get 1,400. Please, just 1 minute. Let me get water. Just 1 minute. Let's continue with the class. Mute. You are welcome to the class. Please mute. All right, we continue. Standard sales prices, that is standard selling price, are 700,000 naira for plasma TVs and 600,000 naira per unit for LCD TVs. Actual sales price achieved during November were 660,000 for plasma TV and 580,000 for LCD. The standard contribution for plasma TVs and LCD TVs are 380,000 and 360,000 per unit respectively. We are done with note 1. Note number 2. Let me scroll up. The sole reason for the variance was increase in the purchase price of one unit of one of its key components. Let's take that again. The sole reason for this variance was an increase in the purchase price of one of its key components. Each plasma TV and each LCD TV requires 1 unit of component X, for which Colade Electronics Limited standard cost is 120,000 naira per unit. That is the original standard cost per unit for components X, 120 per unit. Due to shortage of components in the marketplace, the market price for November went up to 170 naira per unit. In our company, we assume that the standard cost for the raw material is 120,000 naira. However, because of shortage of this component in the market, the market price for November has went up to 170. We didn't know that the price has gone to 170 for component X. Colade Electronics Limited actually paid 160 naira per unit for these components. All right. Note number 3. Each plasma TV, Mr. Ibrahim, please mute. You might not know, so please mute and keep your secrets. Because some might be discussing with their wife at home. Each plasma TV uses 2 standard hours of labor, and each SCD uses 1.5 standard hours of labor. The standard cost for labor is 140,000 naira per hour. This also reflects the actual cost. Look at that, means standard labor cost per hour is also actual labor cost per hour for the company's permanent staff. Our plan is to pay 140,000 naira per hour, and we actually pay 140,000 naira per hour for our own permanent staff in November. However, because of the increase in sales and production volumes in November, the company also had to use additional temporary labor at the higher cost of 180,000 per hour. What that means is that because there's increase in production, our staff cannot cope. We now have to hire temporary employees, temporary labor, and we pay them at an higher cost of 180,000 naira per hour. The total capacity of Colade Electronics Limited, permanent staff. Let me take that again. The total 100 hours production per month. Our permanent staff, our own staff can only supply 2,200 hours for production in a month, assuming full efficiency. In the month of July, the permanent workforce were wholly efficient. Our workers were efficient, taking exactly 2 hours to complete each plasma and exactly 1.5 hours to produce each SCD. Our staff, our own staff, they are very efficient. They work within standard. The total labor variance, therefore, relates solely to the temporary workers. The temporary workers are not efficient. So, the total labor variance relates solely to the temporary workers who took twice as long as the permanent worker to complete their production. Look at that. Please. By the noise of a question. In exam, keep your head straight. You are giving question on variance. Study the formula we have discussed. Let's go to requirement A. The question may be long. Keep your head straight in the exam. Meaning remain focused. Calculate for the month of November, showing all workings clearly. The sales price variance and the sales volume contribution variance. Now ask yourself, we calculated this yesterday. If I want to calculate sales price variance, what is the formula? Actual selling price minus standard multiplied by actual quantity sold. If I want to calculate sales price variance, what is the formula? Please don't be disturbed by the length of a question. Just go and pick your required variables. We start with this. Like saying you have gone to the market. Don't be disturbed by the noise of the market. Market is always when you get to the market, buy whatever you want to buy and walk out gently. All right. We have two products here. We have plasma TV. So I'll come here. The first one, sales price variance. Don't forget the formula. Actual sales price minus standard sales price multiplied by actual quantity sold. Now I have two products. Open a table. We have plasma TV and we have LCD TV. TVs. Then actual selling price minus standard selling price. Differences in price. Let me reduce this one. Because of differences in price, then actual quantity sold, my variance. Go back to the question. Look at note number 1. The actual sales price achieved during November, 660 for plasma TV, 580 for LCD. Standard selling price 700 for plasma, 600 for LCD. Actual volume, I can come here. Actual selling price 660,000, 580,000. Standard selling price 700,000. Yeah, 600,000. Please get differences in price. This is 60,000. Differences, this is negative. This minus this. This is 40, Abino.
This is 40, it is 40,000, and the second one is 20,000.
Yeah, thanks. This is 40. This is negative 20. Actual quantity sold for plasma 750. For SCD 650. Please get your variance. 40 multiplied by 750. Get your calculator closer, please.
That is 30 million.
Please, we are going to shorten this because of space. 30 million adverse. The second one.
Um, 13 million adverse.
13 million adverse. This 13 million. 13 million A. Please sum the two together. 43 million. 43 million A. You are done with the sales variance. Sales price variance. Our sales price variance. Sales price variance. 43 million A. Next. Sales volume contribution variance. That means the examiner wants to use marginal costing. Examiner wants to use what? Marginal cost. What is the formula here? Actual quantity sold minus budgeted quantity multiplied by standard contribution. I'll come here. Your products, we have two products. We have plasma LCD. Actual quantity sold 750, 650. Budgeted quantity. Now, if you go back to note number 1, you have 1,180 total. Examiner says equal mix divided by 2. That means budget is 590 LCD, 590 plasma. Look at it here, please. How we get that? The budgeted total sales volume for TVs was 1,180 units, consisting of equal mix of plasma and XCD. Equal mix means we are going to share this 1,180 into equal. Plasma will take 50%. Our budget is to do 50%, 50%. 50% for plasma TV, 50% for SCD. That was the company's budget. Now look at here. The standard contribution. Look at note number 1. All the information you needed for question Roma figure 1 is in note 1. The standard contribution for plasma TV and for SCD are 380,000 and 360,000 respectively. You come here. Differences in quantity. Get the differences. 750 minus 590. 160.
Then 60.
This is 60. Now your standard contribution. Here you have 380,000. Here you have 360,000. You can write your own in full. CX, standard contribution. It's because of space I'm shorting this. Now our variance. 160 multiplied by 380,000. 60.8 million.
60,800,000.
60.8 million. Favorable. 60 multiplied by 360.
21,600.
21.6 million. Favorable. Sum the two together.
$82,400.
Thank you. 82.4 million air. I can write it in full here. Space volume contribution variance. 82,400,000 favorable. You are done with that. We have resolved A Roma figure 1. Now, A Roma figure 2. Sorry for the break. Let me take water. Now remember, material price planning variance. I want to know the error in our plan, in our price. I'll come here. Material price. No, I hope you're online. Planning variance. That is, if I want to give this formula now, X ante standard price, that is standard price with error, minus X post standard price without error, multiplied by actual quantity of material. Let's now go and pick it. Let's go to the question and pick what we require. Material price planning variance. I want to know the amount of errors in our price, material price. The amount of errors in our standard material price. Now come here. Please follow me on this. Go to note number 2. Look at note number 2. All the information required is in note number 2. Examiner says the sole reason for note number 2. Go to note number 2. Look at note number 2. Material price variance, note number 2. Examiner says the sole reason for this variance was an increase in the purchase price of one of its key components, X. Each plasma TV and each LCD TV requires 1 unit of component X. So if I manufacture, to manufacture 1 plasma, I require 1 unit of X, material X. To manufacture LCD, I require 1 unit. For which Colade Electronics Limited, standard cost is 120. Our original standard cost is 120. That is X ante standard cost. Due to shortage of components in the marketplace, the market price for November went up to 170. That means the standard price should have been 170. Let's pick it now. X ante standard price is 120,000 naira. The market price, due to shortage of this component in the marketplace, the market price of component S went up to 170. That means this original standard price is outdated. The standard price should have been 170 as post standard material price. As post standard price is 170. Actual quantity purchase. Examiner says to produce 1 unit of plasma, we require 1 unit of component X. And to produce 1 unit of SCD, we require 1 unit of component S also. Actual production is our actual production. Both plasma and SCD, 1,400. That means actual material purchase is 1,400 component X. We produce 1,400. And to produce 1 unit of TV, you require 1 unit of material X. That means the actual component X purchase is 1,400 units. So if you want to get your material price planning variance,
Hello, Mr. Suraju. Sorry, I'm sorry to cut in. I said I don't understand your analysis just now. Please, could you take it back?
Which one is that?
This exposed to an ex ante
standard.
Yes.
The standard material price with error. Is that clear?
You said the standard material price with error.
That contain errors.
Oh, that contains error. Okay. Okay. And the exposed doesn't contain any error.
Okay, good. Now, if you go back to the question. Now look at it. Look at note number 2. Note number 2. That is material price variance. It's referring to this note here now. This material price variance. Examiner want to explain it. We are listening. The sole reason for this variance was an increase in the purchase price of one of its key components, X. Each plasma TV and each LCD TV requires 1 unit of component X. That means we produce 1,400 television. That means we are going to purchase 1,400 units of component X. Since we produce 1,400 televisions, both plasma and LCD, it means that the component, raw material component S purchase will be 1,400 units. We settle that. For which Colade Electronics Limited, standard cost is 120,000 naira per unit. Our standard material cost for component S is 120 per unit. Due to shortage of components in the marketplace, the market price for November went up to 170. That means this standard cost of 120 is no longer valid. It has become outdated. It contains error. Due to shortage of components in the market price for component X has went up to 170. That 170 is the standard cost, standard price without error, a revised standard. Colade actually purchased for 160. That is actual material price is 160. I don't need this now. Is it better, please? The class is silent. Is it better, please?
Yes,
120 minus 170 multiplied by 1,400. Actual material purchase. This will give you your material price planning variance. Original standard price is 120. This 120 is no longer valid because the price has went up to 170. This is exposed. This is ex ante. Exposed. Difference between the two, -50 multiplied by 1,400. That will give you a material price planning variance. $70 million. $70 million advance. This is the amount of errors in our plan. Then material price operational variance. Material price operational variance. Here we compare expo standard and actual. If you have to calculate this, X post standard cost minus actual expo standard price expo standard price minus actual material price multiplied by actual quantity. Expo standard material price 170. Actual material price 160. Check note number 2. Actual quantity of component X purchase 1,400. This is 40 million favorable. Now we're able to prove that this 56 million that we have $14 million favorable. If you are looking at this now, I'm going back to that question. This 56 million adverse is not due to the purchasing officer's efficiency. It's because there is error in the original standard. We cannot blame the purchasing officer for errors committed by management. As a business person, you are supposed to be abreast of what happens in the market on a daily basis. If you look at the market women, they call themselves the price of rice today, the price of rice in 1 hour may change. Between 1 hour, the price may change again. As a business person, you must keep yourself abreast of current information. So it is the fault of the company that they are still using a price of 120 standard cost. Meanwhile, the price of the raw materials, the price of component X has gone up in the market to 170. Ibrahim, any question for us? Oh. A3. You have treated 4 marks, 4 marks. Requirement A3. The labor rate variance and the labor efficiency variance, 5 marks. The first one is for 4 marks. Second one for 4 marks, 8 marks. Aromatic got 3. We have treated these. You are likely to have question on variance in your exam. It was tested last night. They are still going to repeat it there. You are likely to have a question there. Variance, budgets, they are always the starting point of the syllabus. Variance, budgets, activity-based costings, all those things will be there. Yeah, relevant costing, those things will be there. Costing being equal. So I want to calculate labor rate variance. Labor efficiency variance. Write the formula down first. Labor formula is rates, labor rates multiplied by actual labor hours. Now let's go and look at this information.
Mr. Shiwaju. Sorry, sir.
Yes, sir.
Okay, so for this formula now, is it because of this the nature of this question? Because the formula I have is standard rate minus actual rate multiplied by actual hours paid. Is it the same thing?
It's the same thing now.
Sir?
When we say standard rate, the standard labor rate now.
Okay.
That standard rate I gave you in class is standard labor rate per hour. It is the same thing.
All right. Okay.
Minus actual labor rate. Who collect rate? Is you that is collecting rate now?
Yes.
Are you not that collect salary in the office?
Yes, I am.
Are the labor now?
All right. Thank you.
The students, they just cram one thing. They don't. Actual labor hours. That is actual labor hours paid. Your actual labor hours is supposed to be actual labor hours paid equal to actual labor hours work. It should be the same thing. So it's the same formula, Mr. Rilwan.
All right, sir. Thank you.
And to every other person too. Why is good to cram formula? I know the exam is very close now, and you got to pass. Try to also explain the formula to yourself. So that you not come and say, actually didn't tell me this in the exam. When we are talking of rates, labor rate is coming from that labor salary. They are paying you per hour. So they can say employee rate per hour. So if the examiner say employee rate per hour, is still saying labor rate per hour. Now let's now go to this. Let's go to it. Total labor variance is given in note number 3. Now let's go to note number 3. Each plasma TV uses 2 standard hours of labor. That means for me to produce a plasma TV, I require 2 hours of labor. And to produce SCD, we require 1.5 hours of labor. The standard cost for labor. The standard cost for labor is 140 per hour. Look at it now, read one. Standard rate per hour is 140,000 naira. Standard cost for labor is 140,000 naira per hour. That is the standard labor rate. At per hour for the company's permanent staff in November. Look at it. The standard rate per hour is the same as actual rate per hour for the company's permanent staff. Our plan is to pay 140,000 naira per hour. And we pay our permanent staff 140. However, because of the increase in sales and production volume in November, the company had to use additional. We have to bring in temporary workers in November. They are not our permanent staff. What you call contract staff, temporarily. We need to hire temporary staff. At the higher cost of 180, our temporary staff, instead of paying them 140,000 naira per hour, we pay them 180. That is actual rate paid to the temporary staff, 180. The total capacity of Colliery Electronics Limited permanent workforce is 2,200 hours production per month. Our home permanent staff, they only have 2,200 hours in a month. Assuming fully efficient, these are in the month of June, it should be November for consistency. It should be November. In the month of November, the permanent workforce were wholly efficient, taking exactly 2 hours to complete each plasma TV and exactly 1.5 hours to produce SCD. Okay. That means our own staff, they don't have any, they didn't create any variance. Our staff are doing well. The problem is for the temporary staff. The total labor variance therefore relate solely to the temporary workers who took twice as long as the permanent staff to complete their production. Let us now take it to calculation. How many hours do we require to produce for actual production? Assuming we are efficient, how many hours are we supposed to use? Look at the working place. The question is not, but it requires more working. Let me take the working down here. Working. Yeah, good night. Calculation of hours required for production. For plasma, we produce 750. And to produce one, you require 2 hours. That will give me 1,500 hours. For plasma TV, we produce 750. And to produce one, you require 2 hours. That means total hours for plasma, 1,500. For XCD, we produce 650. And to produce one, we require 1.5 hours of labor. Please multiply. 650. We require 975. That means total hours required. Formation. We require 2,475 hours. Total hours required. $2,475. Hours available from permanent staff. Hours available from permanent staff. Examiner say 2,200. The difference.
$275.
275 hours. This is the hours the temporary staff we need to contribute. Why are we
Mr.
taking
Ashwaju.
temporary staff? Because our permanent staff cannot take care of all the production. Production volume has increased. These hours is supposed to be supplied by temporary staff now. Now, examiner now say temporary staff. These hours, this one is for efficient staff. If you are efficient, you work within 2 hours for plasma, and you work within 1.5 for SAD. Now, examiner now says, this is the hours the temporary staff should give us. But these temporary staff are not efficient. Look at it, please. This is the standard hours. This is the standard hours. Standard hours for efficient staff, standard hours. For efficient staff, these standard hours. But examiner says we're almost done. Look at the last paragraph here. Look at the last paragraph, guys. Examiner says the total labor variance therefore relates solely to the temporary workers who took twice as long as the permanent staff. Because they are not efficient, they are going to spend, they took twice. Now, this is the standard hour they should have used. Because they are not efficient, actual hour use times 2 of these. Actual hours. 275 multiplied by 2. They took twice as long as the permanent staff. That means the actual hour use is 550. Normally they should have used 275. They use 550. If you now want to calculate your variance, standard labor rate per hour, 140. Actual labor rate paid to temporary staff, 180. Actual hour used by temporary staff, 550. That will give you your labor rate variance. You have 22 million adverse. Labor efficiency variance without wasting time. Labor efficiency variance. Remember the formula. Standard hours produced. Standard hours for actual production minus actual hour multiplied by standard rates, standard labor rates. Standard hours for production we have calculated Assuming you are efficient, the standard hour should be 275 hours. Actual hour used by temporary staff, 550 hours. Multiply by the standard rate per hour, 140,000. You have 38,500,000 A. You are done with that question. You are done with all the calculation. The B part is theory. Yes, to see.
Yes, sir. Please, I missed the part of the 550. How we got the 550 hours? Please
All right, no
kindly.
problem.
Yes, sir.
Let me refer you to this side. That you can appreciate how we get the 550. Look at the last paragraph here. Note number 3. The total labor variance relates solely to the temporary workers who took twice as long as the permanent worker to complete their production. That means if permanent staff is using 2 hours, temporary staff will use 4 hours. If permanent staff is using 1.5 hours, temporary staff will use 3 hours because they are inexperienced and they are not efficient. We now calculate. Look at the calculation here. Calculation of hours required for production. We produce 750 plasma. And to produce one standard require 2 hours. That means standard hours for actual production for plasma should be 1,500 hours. For SCD, we produce actual production 650. And to produce one standard hour, 1.5 hours. We multiply to get 975. Actual hour required standard 2,475 hours. Hours available from permanent staff. Examiner gave us in the question. Those do you have the question with you?
Yes, sir.
Now refer to here. Look at it. The total capacity of Olade Electronics Limited permanent staff is 2,220 hours production per month. That means our permanent staff, they don't do overtime. Once they finish their work, they are going home. In a month, they will only work 2,200 hours. But for we to meet our to meet the demand, the hours we require standard is 2,475. We are going to get 2,200 from permanent staff. That means we are left with the difference, 275,000 hours standard, which we are going to get from temporary staff. Examiner says temporary staff, they work 2 hours, take 2 hours more than permanent staff. Look at the 550. They are going to take twice. They do twice. They spend twice hours. 275 standard hours. Because they are not experienced, they are going to use 550 hours. Amen. That reminds me of my friend. Amen. Please, Nilson. Amen. Maybe you are Akwa Ibom, Calabar, I don't know. So that's how we get the 550.
All right. Thank you.
All right, let's round up this question. Last diet was the first for the new syllabus. So that is the first, that was the first diet for that new syllabus, for the new syllabus. So you are still likely to have question on variance. You are likely to have question on budgets. It's the starting of the syllabus. You are likely to have it again. The last aspect of the question, explain the reasons why Colade Limited would be interested in material price planning variance and material price operational variance. In summary, why are we interested in material price planning variance? It enables us to know the amount of errors included in our original standard. The price planning variance enables the company to identify the amount of errors included in the original standard material price. Why the price operational variance? Compares a revised standard without errors with actual material price. This can be used for performance evaluation. The notice here, you can read it, but we have done the summary. Look at it. Before the material price planning and operational variances were calculated, the only information available as regard material purchasing was that there were adverse material price variance of 56 million. The purchasing departments will be assessed on the basis of this variance. Yet, on its own, it is not a reliable indicator. Yeah, that variance is not a reliable indicator of the purchasing department efficiency. The reason it is not suitable. It is not a reliable indicator because the reason why it is not a reliable indicator is because market conditions can change, leading to an increase in price. And this change in market condition is not within the control of the purchasing department. Yeah. If you look at the question, management set a standard material cost of 120. Meanwhile, in the market, the price has gone up as a result of shortage of the components in the market. Management is not aware that the price of component S has went up. They are still using the old price of 120,000. That old price is not reliable. It cannot be used to measure the performance of the purchasing department. The change in market condition is not within the control of the purchasing department. By analyzing the material price variance further and breaking it down into planning and operational variance, the variance actually becomes more useful assessment tool. The planning variance represents the uncontrollable variables, while the operational variance represents the controllable elements. The planning variance is really useful for providing feedback on how skilled management is in estimating future price. You can do more of the reading. So we are done with this question. If you don't use extra time today, yesterday I didn't sleep until like 1 a.m. We have like 30 minutes. Just we solve again, and that will not take long.
Yeah, hello, Mr. Shoraju. Before we solve another question, I just want to ask this question. Is it a rule of thumb, like where you have where you have notes like this one we just solved, note 1, note 2, note 3, and then requirement question 1. Is there a rule of thumb that the note 1 is related to question 1?
No. No, it's not. At times, the examiner will just scatter everything.
Okay.
At times, the examiner will also look at it. No, this thing is actually long. To reduce student stress, they will just put it. Like this one is meant to reduce the stress. So it's not like a standard rule that question 1 must do note 1. Is that clear, sir?
All clear, sir.
We have solved question on. Need to solve question on material mix for you guys. We have solved this. This take care of. Okay, we have solved material mix. Have you discussed material mix? Take it to material mix. Let me look at this question that we solved. And take me to Is he here now, Elijah? Elijah, please mute. Look. Please, can you mute? What's his name, Seth?
Exclamate your mind.
Miss you. Let me take.
Now, what do you want? Question.
Please, can you mute your speaker? Elijah.
No, what do you want?
This thing disturb my ear.
So you don't want
Exclamate your mind.
You see, you use your back. I ask you so you I open the door to me now. And the same thing I asked you. I'm not saying it's true the one. Stand up. I want two of them. Because then I want.
I don't even know the guy. I don't know whether he's coming from online class or. Can you mute your speaker?
Esla, please help us move into your mic. Esla Elia.
Elia, please can you mute? You are in this class, you are doing your personal business, you are disturbing us. It's just that I have been removing these students. What is going on? I don't know which one they will do for you guys. All this question I'm looking at. Okay, let's even anywhere we get to. Please go to page 144, question 7. Page 144. Page 114, sorry. Let's review this question. If you check page 114, question 7. I'll read. Chocolate. It's a company which and say 3 types. One of them is called Zo or Zos. Okay, and contain 3 types of sweeteners: honey, sugar, and syrup. So these biscuits using 3 types of sweeteners: honey, sugar, and syrup. The standard material usage and cost for 1 unit of whole 1 packet is as follows. To produce a unit, honey, sugar, and syrup, we require 20 grams of honey at a price of 0.02 per gram. We require 15 grams of sugar at a price of 0.03 per gram. We require 10 grams of syrup at a price of 0.025. So what you have here is material cost per unit. For material honey, 0.4 per unit. For material sugar, 0.45. For material syrup. Because I said you must differentiate between material price per gram and material price per unit. Next. In the 3 months ending 30th November, Chokes and Co. produced 101,000 units of the product. Actual production is 101,000 units using 2,200 kg of honey, 1,400 kg of sugar, 1,150 kg of syrup. Notes, there are 1,000 grams in a kilogram. That means 1 kilogram is equal to, that is 1,000 grams in a kilogram. We have to work with the same units. (1,000 grams in a kilogram). Chokes and Co. has used activity-based costing to allocate its overhead for a number of years. One of its main overheads is machine setup cost. In the 3 months ended 30th, the following information was available in relation to the setup. Our budget, actual number of units produced, budget, total number of units produced, budget, number of setup, total setup cost, actual unit produced, total number of setup, total setup cost. Requirements A. Calculate the following variances for material in zone. Material usage variance, then material mix and material yield. Let's take this. Like I said, do not be disturbed by the noise of your question. Don't ever be disturbed by the noise of the question. If I'm to calculate material usage variance, what is the formula for material usage variance? Material usage variance. Standard material for actual production minus actual material for actual material use multiplied by standard material price. Now come here. Our actual production is 110. Our actual production is 110. 101,000, sorry. And examiner says standard. I require 20 grams. But we need to convert, this is kilograms. Examiner says note, there are 1,000 grams in a kilogram. That means if I use . 2,200 kilograms. If I want to convert it to grams, (2,200) multiplied by 1,000. (1,000 grams) in a kilograms. If I want to convert this to kilograms now, that means I'm going to have, let's look at it. Yeah, let's go to it. Please look at it. Let's start from here. Let's start from here. My actual production in the month is 101,000 units. To produce one for honey, I require 20 grams. So if I produce 101,000, how many grams am I supposed to use? Come here, let's come and do our workings. Open your table, the materials. You have sugar, you have honey, and you have syrup. The first one is standard material for actual production minus actual material differences in usage, then multiply by the standard price. I will now get my variance. Now let's move fast. Look at the first one. Let me do this work okay here. Let me create more space, because I'm afraid that, okay, let me put the work here. Calculation of standard material for actual production. I have sugar, our actual production is 101,000. To produce one, I require 20 grams of sugar, standard. Please multiply. 2,000,000 0.2000 grams. If I go to zero, honey, actual production is 101,000. And to produce one for zero, let me go back to that question. Multiply by 15 grams. What do you have? I'm supposed to use 1. Here you are going to have 1,101,000 grams. This is the standard material for actual production in grams. 2020. Come here. Here we require in grams this 2000. Here 151500 101000. Actual material use. Yes, Tolu.
Sir, please, can you go back to your workings? Sir, I think sugar is the number of gram is 15 gram, honey is 20 gram, and syrup is 10 grams.
Yeah, let's check together. Oh, honey is starting first, Abby.
Yes, sir.
Oh, thank you. I'll just
Okay.
change it.
Okay.
Honey is starting first. Honey, sugar, syrup. Thank you. I'll just change this. Honey, sugar. Thanks. You have gotten standard material for actual production. What is the actual material used? Examiner says using, look at actual, 2,200 kg of honey, 1,400 kg of sugar, 1,050 of syrup. Now note, 1,000 grams is in a there are 1,000 grams in a kilogram. Please multiply this by 1,000. That will take it to 2 million. Convert to gram. This is 2,200,000. This will give you 1,400,000. The last one, actual, 1,050. Multiply by 1,000. 105000. You have gotten actual material use. Everything is now in gram. Look for the difference. 2020 minus 220. This is negative
180,000.
180,000 negative. 1515 minus 14. This is
115.
positive 11500. The last one. Oh, it's positive now.
Yes, it is
Put in
positive.
bracket.
The last one, negative 40,000.
The last one, negative 40,000. So please don't be disturbed by the noise of the question. Now multiply by the standard material price. In grams, please don't, this is in units. 0, you know the materials are in grams. You are going to pick 0.02 per gram. If you work for you, examiner brought this question for you. That question we treated, tested last night, it was taken from ACCA. This question too is ACCA. Take this again. 0.0 per gram. So when you are picking your cost, know the cost to pick. There's cost per kilogram. There's cost per unit. If you are dealing in kilograms, pick cost per kilogram. Now I'm dealing in grams, 0.03. The last one, 0.025. This is 0.03, 0.025. Get your variance. 180,000 multiplied by 0.2. This is 3,600 adverse. Next, 115,000 multiplied by 0.0. 3450.
Variable.
The last one.
1,000 adverse.
1,000A. Your final answer.
1150 adverse.
1150A. You have got your material usage variance. We now want to subdivide into material mix and material usage variance. Please look at it. Even though I don't want to go extra, but I want to try and at least let me solve this material mix and material usage for you. Material mix variance. The formula is, first pick your material. We have the material, we have honey. Let me use space. Let me use here, please. Material, we have honey, we have sugar, we have syrup. Actual material is standard mix. Actual material in standard mix. You always take space. And if you don't put these things, students might be struggling to know what is there. Actual material in standard mix minus actual material in actual mix. Differences in mix, standard price, variance. This one you have is your actual material in actual mix pick everything here. 1, 2, 3. For convenience, I'm going to reduce to 30. Maybe I can manage this. This is 2,200,000. This is 1,400,000. This is 1,050,000. Now get the total. Sum of the total. 220 plus 1,400 plus 1,050. This will give you 465,000. Now get actual material in standard needs. Look at how to work it. Don't worry. I'll go to working too. Tolu, you can hands down. Working too. Working too. Actual material in standard mix. We have honey. We have space. We have sugar. We have syrup. Standard here is 20. Here is 15. Here is 10. Please sum up. This is 45. Abi? 35. This is 45, is that not?
Yes, sir.
Now come here. 20 over 45 multiplied by 4,065,000. Get, this is actual material in standard needs. Come here. 15 over 45 multiplied by 465,000. 10 over 45 multiplied by 465,000. Get your actual material in standard mix. $465 divided by 45. You give us rounding off problem. Multiply by 20. Here you are going to have 2,066,667 approximately. This is 15. Here you are going to have round-off figure. 1,550,00. Last one. Here you are going to have 1,033,333. That is actual material in standard needs. Return up here. Here I have 2,066,667 1,550,00 1,033,333. If you sum up this total, it must give you 4,650,000. The difference now. Two zero 66667 minus 22. Here I have negative 133,333. Next, 1550 minus 140. Here I have 150,000 460. Last one, 103333 minus 1050 000. Here I have negative 16667. At the end of the day, this must give you nil. If you don't have 0, that means there's error. Multiply by your standard price. This material are in grams. 0.02, 0.03, 0.025. I have to battle with space now. So please, I'll have to bring this down small here. Because of space, variances, the first one or the last one multiplied by 0.025. Here I have negative variance.
That is 26666.66.
Which one is
2066
that?
for honey.
Here I have 2666.66.
66. Yes,
Oh,
Adwa.
sorry. I have to repeat this. Honey, sugar, syrup, 2666.66. Next, 150 multiplied by 0.3. This is A for
That is
5,000 F.
48,000. Yes.
16667 multiplied by this 22.
That is 416.675 adverse.
416.675 total adverse. Please get your total material mix variance.
Okay,
That is
1,416.
1,416.665. That is favorable.
Favorable.
Yes, sir.
1,000 what?
1,416.665.
1,416.665.
665.
A. Okay.
No, F.
Oh, F, favorable. We shall be done now, don't worry. It's just this space. Now your material yield. Standard quantity in standard mix. If I come here, your material yield, variance. Let's put the formula here. We have the material, standard quantity in standard mix minus actual quantity in standard mix. Differences in mix multiplied by your standard price. All what you require is available. It's just to pick them. Our material, honey, sugar, and syrup. Your standard quantity in standard mix is already here. Standard material for in standard mix. This is what we are supposed to use. Pick this 2020, 15, 15, 10, 10. If I come here, 202000 151500 101000. Actual material in standard mix. This is my actual material in standard mix. 2066-667 155000 1033 differences minus 2066-667 negative y negative 46667 multiplied by 0.02. Difference here 1515 minus 1550 negative, no, this negative, yeah, negative 35,000 multiplied by 0.03. Next. 101,000 minus 1,033,333 negative 23,333 multiplied by 0.025. So if you are doing your own, the space should be enough. Let me just come here. Just come here. Let me do it once and for all. I can't be doing 1 now. Return back here now. Go. Now pick your pen. My variance now, because of space, I'll pick honey. I have sugar. I have syrup. Now multiply.
Honey is 933.34 adverse.
933.34A. Next.
Sugar is 1,050 naira adverse.
1050A.
Then syrup is 583.325.
583.325A. Total A.
Total is 2,566.665.
2,566.665. 665A. Now, if you want to confirm, here you have favorable. The other one you have adverse. If you now want to confirm your usage variance, our usage variance, we have favorable 1416.66, Abby. I'm not even sure now. 1416.665 A. That's F, Abby.
Yes,
plus
sir.
266 what?
2566.
25. 2566.665 A. Final answer.
That should give you 1,150 adverse.
That
Okay.
confirm what you get before, Abby.
Yes, sir.
1150A. Remember we said your usage variance can be subdivided into two. Our usage variance is calculated as this. We now subdivide this into material mix and material yield. When you add your material mix and your material yield, it must give you back what you calculated for your material usage. Ladies and gentlemen, we shall stop the class here. And by extension, we shall be ending the class for the dice. So once again, thank you for your cooperation.
Thank you, sir.
Sacrifices. Our step to success.
Amen.
We'll be stepping out. A blessed evening. Good night and God bless.
Thank you, sir.